In 2008, the world faced one of the most severe financial crises since the Great Depression. To understand this complex event, we need to break it down into a few key components. The crisis was primarily caused by a combination of risky banking practices, an overheated housing market, and the failure of financial regulations. Let's start with the housing bubble. In the early 2000s, low interest rates encouraged people to buy homes, and many lenders offered easy credit to borrowers, even those who couldn't afford it. This led to an explosion in housing prices. As more people bought homes, the demand drove prices even higher, creating what's known as a housing bubble. Many believed that housing prices would continue to rise indefinitely, leading to risky investments. To make matters worse, banks began bundling these risky mortgages into complex financial products called mortgage-backed securities. These securities were sold to investors who were often unaware of the underlying risks. The idea was that even if some homeowners defaulted, the majority would pay their mortgages, making these securities appear safe and profitable. Unfortunately, this was a dangerous illusion. As the bubble burst in 2006, housing prices began to fall, and many homeowners found themselves owing more than their homes were worth. Defaults and foreclosures skyrocketed. The mortgage-backed securities, which were once seen as gold, quickly became toxic. As banks and financial institutions began to realize the extent of their losses, panic ensued. The fallout from the crisis was widespread. Major financial institutions like Lehman Brothers went bankrupt, triggering a domino effect across the global economy. Stock markets plummeted, and millions lost their jobs as businesses struggled to survive. The crisis exposed significant weaknesses in the financial system, including inadequate regulation and oversight. In response to the crisis, governments and central banks stepped in with unprecedented measures. The U.S. government, for instance, initiated bailouts for major banks and financial institutions to prevent further collapses. The Federal Reserve lowered interest rates and implemented quantitative easing to stimulate the economy. These actions helped stabilize the financial system, but also led to debates about moral hazard and the long-term implications for the economy. In summary, the 2008 financial crisis was a result of a housing bubble, risky banking practices, and the failure of regulatory systems. It taught us valuable lessons about the importance of financial oversight, the dangers of excessive risk-taking, and the interconnectedness of global economies. Today, as we look back, it's essential to remember these lessons to prevent similar crises in the future. Understanding the complexities of the 2008 crisis helps us appreciate the need for responsible financial practices and the importance of regulation in safeguarding our economies.